Hey everybody, welcome to the channel. Soil here, and today I want to talk about dollar cost averaging, which is an investment strategy that can help you lower the amount you pay for investments and minimize risk. There are many investment strategies, and one of the most common one is saving money and then buying the asset at the right time, actually buying the dip. In this method, you invest big. Actually, you make a one-time purchase at your favorable moment or price. Discovering market structure and possible next move at any point is extremely difficult, especially for beginners. There is no way to certainly find out what is going on behind the scene. Maybe it's a distribution period and the price is going to decline more, or maybe it's accumulation period and the smart money is entering the market to push the price up. No matter what the structure of the market is or how much correctly you could identify changes in the market, as an investor you're always exposed to risk, and you should always try to minimize your risk as much as possible. One of the investment strategies that lower your risk and help you to pay lower amounts for your investment is dollar cost averaging. In this strategy, you leave money aside every week, every month, or any period of your choice, and you buy bit by bit. You don't care where the market is heading, and you just stay consistent and buy in spite of volatility. By the help of dollar cost averaging, you actually distribute your capital to an asset over time. This strategy negates the effects of short-term volatility and helps investors to accumulate wealth by paying lower cost on average and reaping more rewards. Statistics show that dollar cost averaging on the long run brings more reward in compared to a strategy of saving money and buy the dip when the market reaches to a low price. In dollar cost averaging, you must have a strict schedule for buying periodically and consistently without caring about price fluctuations. By doing so, you don't spend all your capital at a bad moment, and you distribute your capital to the asset over time. Your buying schedule can be every week, every other week, every month, or even every day for a very tight distribution of your capital. Let's see an example to make it more clear for you. Consider you're an employee in a company and you earn, for example, $5,000 per month, and you want to invest in Bitcoin. You decide to buy Bitcoin with 10% of your salary, and you want to do it on a weekly basis and actually distribute your allocation each week. So with $500 allocated for investing in Bitcoin, you buy $125 worth of Bitcoin every week, and you do this for 1 year. Consider you started doing this last year and now you want to evaluate the result. There is a dollar cost averaging calculator for Bitcoin which can help you to quickly calculate the result. So you started last year, 1 year ago. The accumulation period is also 1 year. You decided to buy regularly every week, so this is also set to weekly, and the purchasing amount every week is $125. So here we enter 125, and here we go. Here it shows the total invested amount, which is $6,625, and the total value for today would be $7,786, 17.5% of change positively, actually 17.5% profit. It may seem a small amount for a crypto asset, but please pay attention that in this period, February last year to today, the market was in a complete range, as you can see. And if you started this, for example, 2 years ago, from here, let's see what would be the result. The starting year 2 years ago, and also accumulate for 2 years. And the repeat purchase is same weekly. And now you can see the result. The total amount invested in this 2 years is $13,125, and the total value of our investment today would be $41,764, 218% profit, more than 3 times of your invested value. And for this example that you started 2 years ago, if you had this investment for 1 year, actually for the second year that the market was ranging, you stopped investing for any reason, the result would be even better, 414% profit, because in this period the market was in a very strong uptrend. By these examples, you may think that the dollar cost averaging is a winning ticket, but you shouldn't just look at it the upside way, and you must also think about it the other way. Consider the price was $60,000 when you started investing by this strategy. strategy, but after that the price started declining, and now after a month of investing the price is $30,000, 50% market decline. The good point with this strategy is that because you distribute your allocations evenly and regularly throughout the drop and you buy at both highs and lows, your entry level on average would be around $45,000. The result would be 25% loss for you, but consider this with a situation you entered the market at $60,000 with all your capital on a one-time purchase. This would result 50% loss. So in bear markets with dollar cost averaging strategy, your entry level on average will move higher in your favor, and this helps you to break even easier because you will need smaller percentage of rise to cover the losses and break even. You can also look at the dollar cost averaging from another perspective. Some investors do not pay any attention to the Bitcoin price, and instead they just focus on collecting as many coins as possible. Until now, Bitcoin has always shown a new record of all-time high, and looking at the strategy in this way also can have benefits for you in long term. So to dollar cost averaging, the first step is to decide which asset you want to buy, and this requires a serious study and research. Then you must decide how much of your capital or how much of your income or salary you want to allocate to that asset. And next, in the final step, you must decide on picking a fixed buying interval. Most investors with this strategy buy once a week, or some prefer every 2 weeks, every month, or even every day to negate volatility as much as possible. But buying on a weekly level is the most common schedule among investors who use dollar cost averaging. The most important part with this strategy is consistently buying based on your schedule in spite of volatility, and by doing so you distribute your capital to the asset over time, and this results paying lower cost on average and reaping more rewards. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it, please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your investing.